Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, August the 12th. I'm Jay Gragnani, and here joining me this week is Ian Saunders. And appreciate everybody taking time out of your day to join us for this podcast this week. And certainly not a lack of things that are happening in the market, and probably, right out of the gates, the biggest headline out there is looking at the market, the S&P 500, which is just recently on the chart. So in the 20-point chart of the S&P 500 has moved back up to 3380, which matched the 20-point chart high that we saw from February, and now puts it very, very close within striking distance of the all-time high, which got up to about 3390 on the S&P 500. And so, we continue to see the market has been tremendously resilient since the end of March, and really for going on almost 5 months now, since the bottom on March 23rd, as investors everywhere continue to digest information that is coming out, everything from vaccines around COVID-19 to the U.S. presidential elections that are going to be taking place here in November in just a couple of months. And so, the market has continued to push and has gotten very, very close to new highs. And, there have been certainly clear areas of leadership within the market so far this year, and those leadership trends, have been within the growth and large cap technology space by and large. But during this rally, Ian, there's been a lot of stocks that have participated. Some have done better than others, but in terms of just the participation that we've seen out of this rally, I mean, you've seen a majority and a pretty big majority of stocks, specifically as it relates to the S&P 500. Those stocks have moved back into positive trends in a big way.
Absolutely, there, Jay. And as you said, I mean, there are a variety of different ways that we can track participation here on the Nasdaq Dorsey Wright Research platform. I mean, looking at the movement for the S&P 500 in and of itself, obviously we're seeing it creep back up and sitting at that resistance point on the 20-point chart, as you said. The index on this chart moved back to a positive trend there in April. But another way that we can track that longer-term participation of the underlying names within the index is through the positive trend chart that we have for the S&P 500, ticker PTSPX, that we have on the platform. And what these positive trend charts are designed to do are track the number of names within a particular basket of securities that you're looking to examine that are trading in an overall positive trend, so above their bullish support lines on their respective point and figure charts. So for the PTSPX chart, it's just saying simply, okay, out of the 500 names we track in the S&P 500, what percentage of names are in a positive trend? And we've seen this indicator moved substantially off of a multi-year low that we saw it reach there in March of this year, all the way down at 8%. So only 8% of names were sitting above their respective bullish support lines in a positive trend. And it rallied off that with the broader market rally, moving all the way to a near-term high at 82%, which matched a high that we saw in 2018. And before that hadn't been seen there since 2014. So definitely very sharp and quick move for that particular indicator. And it does speak to the long-term nature of it. We see that this indicator throughout history doesn't typically have all that many column reversals per year. Looking at only just under 4 column reversals typically on an annual basis. And we're already sitting at 4 this year after the market movement that we saw on Tuesday. This indicator moved again up to that 82% level. It reversed down in June and fell down to 70% in July, and sat there for the remainder of the month up until yesterday. Reversed it back up into a column of X's at 78%. So just showing that long-term participation, more names are participating to the upside, as you said, looking a little bit more longer-term perspective than something like your bullish percent charts. Stocks will obviously return to buy signals before they return to overall positive trends. So just thinking about it from a time horizon perspective. But this indicator reversing back up, the new column of X is at 78%. Does bode well for looking at things from a performance standpoint. Decided to take a look at this chart, and really the line of demarcation that we typically use on the positive trend charts is that 50% level. So ideally, you'd rather have more than half of the names in the particular basket you're looking at be in an overall positive trend. And so if we take a look at the number of reversals that we've had in the history of this indicator, which we had dating back to about mid-2000, there's been a total of 74 reversals, either up or down, so X's or O's. And 20 of those reversals have occurred when we've gotten a reversal up into X's when the indicator has been above 50%. And then looking at those 20 times, we see pretty strong performance, or at least all positive performance, looking out at forward returns for the index from that point. Looking at 1 week, 2 week, 1 month, and 6 month, they're all going to be positive returns, positive forward returns on average once we get a reversal up while we're above 50%, with the 2 week being above 1% return on average, and then carrying out to the 6 month above 3% there. Then where we see this actually further is in looking at another indicator. Another indicator we saw reverse back up into a column of X's there after trading yesterday was the PT NYSE. So instead of looking at just the 500 names in the S&P 500, the PT NYSE is going to be looking at a broader list of names, looking to identify which names in the about 2,000 names in the New York Stock Exchange are trading above their respective bullish support lines. We saw this indicator move out to 56% there in June and then fall back down to touch that 50% level in July of this year. So sat there right at that 50% point, but didn't quite go down low enough to drop below that level. And then ultimately, after movement there yesterday, reversed back up into a complex at 56%. And so if we carry over that forward performance aspect for the PT NYSE, we see that this actually enhanced those forward returns. You're not looking at quite as many reversals for this particular indicator as the PT SPX, because it's more difficult to get to those column reversals when you're looking at a broader inventory of names. So not seeing quite as many reversals back up above 50, looking at 12 throughout the history of this indicator going back to 1997. But over 2/3 of each of the performance aspects we looked at, forward returns, 1 week, 2 week, 1 month, and 6 months, all of those had more than 2/3 of each of those times were going to be positive returns moving forward. Looking at a 1 week return from the reversal up of in excess of 1% positive return, moving out just under 1.3% on a 2 week basis, almost 2% if you're looking a month out, and then looking 6 months out from the reversal back up into a column of X's above 50%, looking at a 4.5% return on average among those times that we're examining. So definitely boding well to the longer term picture, another kind of positive way to the evidence that we can add on to the case for domestic equities on the backs of some other recent indicator changes that we've seen over the past week or so here, right, Jeff?
Yeah, and I think it's important. You look at sticking on the PT NYSE there for a second. I mean, historically we've seen market environments in which that indicator is above 50%, which just simply suggests that a majority of stocks are in positive trends. Those have generally been pretty healthy market environments. And it's interesting the way that this chart played out here recently. As it pulled back right to 50%. The chart never fell below 50%, and very similar to how the chart played out back in June, July of 2009, that time period where you pulled back to 50% in July of 2009, held at 50%, reversed back up, and ultimately moved all the way up to 80%. Similarly, in June of 2012, that indicator fell right to 50% and held. And so, that 50% line has been, historically a very interesting line that the chart has tested a number of times historically. And, once again, this time, at least for the time being, has held that 50% level. And you think about, the difference in the NYSE universe being a little bit more small cap bias, but a reversal back up certainly suggests that you're seeing quite a bit of participation from the small cap areas that have joined the large cap. And that broadening out of the strength across the equity market has ultimately translated into seeing domestic equities within Dolly move back up into the top 2 spots. And over the course of the past week, domestic equity overtook cash in the Dolly asset class ranking. And, there's certainly the market has rallied notably off the lows, but it was really recently that you've seen that rally broadening out, meaning you're getting a lot of participation from a lot of different areas of the equity market, as opposed to just a very, very concentrated rally from, large cap technology by and large that you saw initially. And so, when we look at domestic equities or U.S. equities in Dolly, it really is measuring a broad swath of the equities market. It's not just one specific index. And so, as the market rally has broadened out, that's how you've seen U.S. equities move back up in the top two spots. Now, within equities, as we can see, large cap growth, mid cap growth, the growth theme, the technology, consumer cyclical theme, those are the areas of strength, and that hasn't changed. So from a relative strength perspective, within the equity market, there hasn't been a lot of change there. You've seen some participation from some of those other areas in absolute basis, but you haven't seen the leadership trends within equities change much. Energy, energy has been interesting. Moved up there a number of months ago, and it's been going back and forth with communication services. But really, you look at those top groups: technology, consumer cyclicals or discretionary, energy, communication services, and healthcare. Those kind of green sectors, those have been the ones that have really carried the baton. And so, as it relates, specifically to equities, and looking at it in Dolly, historically, going back to the end of '99, this has really been the fourth market event where domestic equity fell below cash. And previously, the three before that, the first one occurred back in the 2001, 2002 time period, where cash was basically ranked higher than domestic equities from about about February of 2001 until about May of 2003. So a couple of years there where cash was above equities. Ultimately, May of '03, and equities remained dominant from 2003 until about mid-2008. July of 2008 is when cash ultimately moved back above. So you had a 5-year stretch there of U.S. equities being dominant. From about July of '08 until May of 2009, cash remained above domestic equities through that bear market of the '08-'09 global financial crisis. By May of '09, domestic equities moved back, stayed there until February of 2016, and 2016 was that ranking played out similar to what we saw earlier this year, where the duration was not very long. It was only about 6 months that cash stayed above domestic equity, only to revert back in August of 2016. And so from August 2016 until March of this year, March 13th, is when that cash moved above domestic equities earlier this year. So again, very similar, this being a 5-month time period that cash remained above domestic equity. But, so this was the fourth time. It played out more like 2016 than it did in the other bear market time periods of 01-02 and then 08-09. Nonetheless, in all three of the previous instances, we have seen when domestic equity has been able to move back above cash. That has historically been a positive sign for the market, more confirmation of the strength in the market that we've seen. And you've seen, a prolonged, years of that trend of U.S. equities being above cash. So, now that we're seeing cash back above, or seeing equities back above cash, that's certainly another positive sign for the equity market as we're moving forward. With that said, there have been a lot of areas, not only within domestic equities. I mean, fixed income is still number one in Dolly. It's very, very close to cash, about 12 signals separating those. But there's been a lot of areas, not only within equities, but a lot of areas within the fixed income market that have participated as well. And you can see that in Dolly with preferreds and convertibles and corporate and high yield, even emerging market and international debt being up there at the top. But a lot of areas within the fixed income market have been doing well this year, and that shows up not only in Dolly, but you can see that a little bit more granularly on that asset class group score page.
Absolutely, there, Jay. And before jumping over that page, there was one other point we had that I did want to hit on here on the Dolly. I mean, a lot of questions we've been getting over the past week or so have been, okay, well, now that cash has moved, domestic equities moved above cash on the page, why is fixed income basically still number one, right? And in looking at it, like you said, we see a lot of those areas up at the top of these of the fixed income relative strength rankings in the Dolly breakdown. These are those areas that are going to be more correlated to equities anyways. Preferred convertibles, corporates, high yields, those areas that are typically that are going to be more positively correlated there to the domestic equities asset class. And another point to keep in mind is that we have had the fixed income asset class falling from a buy signal perspective along with cash while this market rally has ensued. It just hasn't been falling as quickly as cash, and that's part of the reason, I guess, why we've seen domestic equities move above cash there first, like we had last week. And part of the reason why we haven't seen it falling as quickly, as you mentioned there, is because a fair amount of areas are still holding up, either from a relative strength perspective, like we can see here on the Dolly page with those top-ranked RS breakdowns, or on that asset class group scores page. And on the asset class group scores page, again, going to be the page ranking 135 different groups, or different basically investable areas of the market that we're going to classify ETFs and mutual funds into. All of those are going to be sorted by the average score, the average fund score of the constituents of each group. Score ranging from 0 to 6, 0 being the worst, 6 being the best. And on this page is meant to represent a very broad depiction, or in-depth but broad depiction of various different investable areas. So everything from individual domestic equity sectors, size and style comparisons, different fixed income classifications, different areas of the international markets, a real broad representation, but more specific representation than some other areas that we have there on the platform. And so out of these 135 groups, we now have 49 of these groups are going to be scoring in what we call the blue sky zone, which essentially means their average group score is north of 4.0. And what would be what we would consider to be those more favorable areas or more favorable groups that we have displayed on the page. So 49 out of the 135 scoring above that zone speaks to that the breadth of the market participation that we see, not only from the domestic equities perspective, but also looking at the fixed income representation. A fair amount of fixed income groups are going to be scoring above this score territory here. So some other areas as well, such as precious metals, more on the commodity side. International specific areas are starting to creep back above that score line as well, most of them being led by China, which has maintained a score above 4 for several weeks at this point. So very broad participation that we see here on this page, with groups scoring above 4.0, leading to most of the groups that we have on the platform possessing average group scores above 3.0. So out of the 135 different areas, 102 of those groups are now going to have a group score above 3.0, which is going to put it in the green territory that we have here on the Nasdaq Dorsey Wright platform on that asset class group scores page. So really interesting to see, and something you don't see that often, that many groups scoring in a high field position with fund scores, or with group scores rather, above 3.0, and specifically looking at those 49 that still possess that group score north of 4.0. And what that's led to is a continued dampening of that money market percentile rank. So on this group scores page, there's two main percentile ranks that we're going to track, one being the money market percentile rank, which essentially is saying, we have a group on here, the U.S. money market group, saying, okay, how strong is cash relative to the rest of your investable universe? What percentage of groups is our cash, is our money market group beating? And we saw that continue to fall over the past couple of weeks, and ultimately falling here over the past few days down below the 10% level, downward to a reading of 9.86% through trading on Tuesday. Dropping below that 10% territory for the first time since the market volatility ensued there with the decline in March. And with that, we also see that the other percentile rank we track, the U.S. equity core percent rank, which tracks essentially the relative position of the S&P 500 index funds group as our core market representative relative to the rest of your investable universe. What percentage is the core market beating? And we see that it's currently at a reading of 92.96%, so almost 93%. So it's beating almost 93% of your investable areas of the market. And so the continued falling of the money market percent rank, or MMPR as we call it, and the continued rise that we see in the U.S. equity core percent rank does speak to the more positive side of the picture for the longer term state of the equity market as well. As we typically see, those prolonged periods of growth come with the dampening of the money market score down beneath that 10% level. So still sitting there at that 9.86%, definitely a place to keep an eye on there. Those of you that do have are subscribers to the research platform can have the potential to set alerts on the relative positioning of these groups if you do have the ESS add-on there. So one thing to keep in mind for those that are subscribers and following along on the platform, but definitely an interesting place to monitor and something we'll continue to bring to your attention as we look towards the end of the summer here. And another move that we see coming on as we continue to see the strength of a lot of these more equity-focused areas is some interesting movement from the currency perspective with the U.S. dollar there, Jack.
Yeah, I mean, as you alluded to, I mean, there's been a lot of things that have been working well, from a participation standpoint, from, stocks moving into positive trends to a relative standpoint, not only within the equity market, but within fixed income. But, one of the areas that has not been doing well this year has been the U.S. dollar. And the U.S. dollar has recently fallen about 10% off its high from back in March, and that that's a pretty big move in a currency, a 10% move in the dollar. But that also enters what we have historically observed as a falling dollar environment, and that is just marked by basically a 10% move lower in the dollar, and that's kind of exactly what we've seen. Seeing it move into a negative trend initially back in May at around 98, has now fallen down to 93 and violated the lows that were seen back in the summer and early fall of 2018 with a move down to 93. Now, when you go back to, it got as low as about 88 and a half back in the beginning of 2018. So, we'll see if the dollar is set to test that, but that's, certainly the next area of any kind of support on the chart there is the 2018 time period. But, it's important when you look at the dollar, and there's certainly some asset classes that are provided some tailwind when it relates to a weakening dollar or a falling dollar environment. And those are things like non-U.S. equities. I mean, emerging markets specifically tend to perform much better in weak dollar environments, as do commodities and international currencies, as basically the other side of the U.S. dollar being pegged against a basket of foreign currencies. But non-U.S. Emerging markets, commodities, and we've seen quite a bit of activity out of the commodities market. Metals, silver and gold pulled back, pretty good here recently, but have had a tremendous run so far this year. Crude oil moving back into a positive trend. So, those are the asset classes that tend to perform better in falling dollar environments than they do in rising dollar environments. As it relates to U.S. equities, small and mid caps tend to do better during rising dollar environments, and growth stocks tend to do better during rising dollar environments. We certainly haven't seen that, but by and large, if you look at rising dollar environments versus falling dollar environments for the S&P 500, it's basically a wash in terms of performance. There isn't really a correlation between performance of the S&P 500 during rising dollar and falling dollar environments. So as much as it provides a tailwind, the falling dollar provides a tailwind to some areas like non-U.S., like commodities. It's real. There's no historical bias towards a weak dollar providing a headwind against the U.S. equities market. So all that being said, I mean, equities can certainly do well in falling dollar type of environments that we're in today. And when we, at the end of the day, when we look across the board and just kind of lay all the chips out on the table, there's certainly more positives for the equity market today than there are negatives as we look at a number of different indicators, whether it's absolute participation indicators like trend, charts like PT charts, or whether it's relative strength areas like Dolly or the asset class group scores. Certainly a continued, weight of the evidence for the equity market remains positive here as the S&P 500 at least looks poised to test those all-time highs from back in February of this year. So with that, I think that's all we had for you this week. I hope everybody is enjoying the rest of the summer, hopefully getting some time to get a little rest and relaxation in there, given the added stress that everybody is working towards now. With that said, as always, we appreciate you joining us this week. Please reach out to us if there's anything that we can do to help you and your business. Please reach out to us. With that said, appreciate you joining us this week and look forward to be back on with you next week.